All right, today we are taking the dense, complex accounting standards from your university textbooks and transforming them into a clear, visually rich, documentary-styled journey. Whether you're studying management accounting, prepping for final exams, or honestly just trying to figure out how a single raw material turns into multiple lines on a financial statement, you are in the exact right place. Welcome to this explainer. Let's break it all down.
Here's our roadmap for today. We'll start with the joint production process, define the split-off point, break down 4 cost allocation methods, tackle the sell or process further decision, clarify byproducts rules, and bring it all home with a comprehensive worked example to get you fully exam ready. Let's jump in.
Starting off with Section 1, the joint production process. Multiple outputs from one source. To really get this, I want you to think about heavy, real-world industries. We're talking meat processing, oil refining, timber manufacturing, mining, or chemical production. What do they all have in common? Well, you put in one raw material, like a barrel of crude oil or a single massive tree, but you get several very different products out. It poses a huge management accounting question. How do you accurately price a premium steak when the exact same cow just gave you a leather jacket, right? It's not just a philosophical riddle, it's the fundamental challenge of a joint production process.
Let's classify these outputs. The main stars of our production line are called joint products. These are products produced simultaneously from a common process that holds significant sales value. They are the primary objective of our manufacturing, the whole reason we run the factory. If you're finding crude oil, your gasoline, and your jet fuel, those are your joint products. On the flip side, we have byproducts. These are the items that emerge incidentally from the production of your major products, holding a relatively minor sales value. Think of sawdust at a timber mill, or the minor chemicals stripped away during oil refining. You aren't running a massive operation just to make sawdust, but you get it anyway, and hey, you can still sell it for a little bit of cash. Moving right along to Section 2, defining the split-off point, the exact moment of separation. Let's physically map out this manufacturing timeline. In Step 1, your raw materials hit the factory floor. In Step 2, they go through the joint production process, heating, cutting, refining, whatever it is. During this stage, the products are not separately identifiable. It's all just one big mixed batch. But suddenly, at Step 3, we hit the split-off point. This is the crucial moment on the production line, where the products finally separate into distinct items. You can literally point and say, okay, that is product A, and that is product B. And here is why that exact moment matters. Before the split-off point, you incur what we call joint costs: materials, labor, overhead, all the money spent while the products were completely mixed together. Because they were mixed, we cannot directly trace those costs to individual products. But, and this is the kicker, according to International Accounting Standard Number 2, or IAS 2, all production costs must be included in your inventory value. We need these valuations for pricing, for profitability analysis, and for our financial reporting. So we are legally required to find a systematic way to chop up and allocate those joint costs. Which brings us perfectly to Section 3, 4 cost allocation methods, essentially slicing the pie. Since we can't physically trace the costs, management has to pick a mathematical lens to allocate them. The 4 methods you absolutely need to have down for your exams are the physical measures method, the sales value method, the net realizable value, or NRV method, and the constant gross profit percentage method. The one you choose depends heavily on your market conditions and your processing stages. Let's look at how they stack up. First, the physical measures method allocates costs based on physical quantities, like gallons. If product A is 80 gallons and B is 20, A gets 80% of the cost. Simple, right? But it totally ignores economic value. Second, the sales value method allocates based on the market price right at the split-off point. If A sells for 10 grand and B for 5, costs are split 2 to 1, matching cost perfectly to revenue. Third is the net realizable value, or NRV method. This is for when a product needs more work before selling. You take its final sales price, subtract the extra processing costs, and boom, you've estimated its split-off value. Finally, the constant gross profit percentage method works backwards to guarantee every single joint product reports the exact same profit margin. It's wild to think about, but using the exact same production data, simply changing your method from physical quantity to sales value, can drastically alter your reported product costs and profits overnight. All right, on to Section 4, sell or process further, making the right call.
Once products reach that split-off point, management faces a massive decision. Do we sell a product right now as is, or do we invest more money to process it into an upgraded product? Listen closely, because this is the #1 trap in management accounting exams. Joint costs are sunk at the split-off point. I'll say it again. All those shared joint costs we just spent time allocating, they are gone, spent. You cannot get them back. Therefore, they are completely irrelevant to your future processing decisions. Do not let test questions trick you with this.
So how do you actually make the decision? It's surprisingly simple. You just isolate the future. To maximize profit, you compare the incremental revenue, the extra cash you get from upgrading the product, against the incremental processing costs, which is the extra money you have to spend to do the upgrade. If the extra revenue is higher than the extra cost, you process further. If the extra cost is higher, you sell it split-off. Just compare future revenue to future cost.
Let's pivot to Section 5, Byproduct Accounting Rules, Handling the Leftovers. So far, we've only talked about the main stars, our joint products. What about the byproducts? The golden rule here is straightforward. Do not allocate joint costs to byproducts. Remember, the major objective of the business is to produce the joint products. You didn't build a massive timber mill for the sawdust, so we don't burden those minor incidental items with heavy joint cost allocations. But, we do still sell those byproducts for a bit of money. So how do we account for that cash? There are generally two ways. You can either take the revenue from selling the byproduct and deduct it straight from the main production costs of your joint products, effectively lowering your overall cost base. Or you can just recognize that revenue separately as other operating income in your journal entries. Either way, treat it as a small financial bonus, not a core revenue driver. Let's bring it all home in Section 6, Summary and Worked Example, Putting It All Together. Let's walk through a concise scenario you would actually see on a test. We start the input stage with $100,000 in raw materials and joint costs. At the split-off point, joint products A and B emerge, alongside a minor byproduct, C. Next, allocation. Using the sales value method, we allocate $60,000 of those sunk costs to A and $40,000 to B. Then, management looks at product B. They realize if they process it further, they can earn an extra $30,000 in revenue for only $10,000 in extra costs. That's a net positive of $20,000. So, of course, they make the decision to process B further. And notice, they completely ignored that $40,000 allocated sunk cost. Finally, they sweep up by product C, sell it for $2,000, and deduct that $2,000 from the main $100,000 input costs. It's clean, logical, and follows the standards perfectly. To really lock this in, here is your ultimate visual summary. Step 1, physical joint production. Step 2, identifying the exact split-off point. Step 3, gathering joint costs and allocating them to major products to satisfy your inventory rules. Step 4, using incremental analysis for sell or process further decisions. And Step 5, accounting for your minor byproduct revenues. Burn this sequence into your memory as it perfectly maps the actual physical production timeline to your accounting standards.
I'll leave you with this final thought to ponder for your exams and honestly for your future careers in management. If a new market suddenly makes your cheap byproduct highly valuable, at what point does it officially get promoted and become a joint product? How dynamic are these classifications in the ever-changing real world of manufacturing? As external markets shift, so too must our internal accounting lenses. Keep that in mind as you study. Thanks for joining me on this explainer, and I'll see you next time.